What if I told you that the retirement portfolio beating 90% of professional fund managers has only 3 moving parts? No stock picking, no day trading, no 57 different funds that you can't even keep track of. Just 3 simple pieces, working together, quietly outperforming people who spend 40 hours a week staring at charts. Sounds impossible, right? It's not. And by the end of this video, you're going to understand exactly why less is genuinely more when it comes to building wealth for retirement. This is Knox, and if you're serious about building real, lasting wealth without the stress and the noise, hit that like button right now and subscribe, because this channel is all about making your money work harder while you work less. Alright, let's get into it. Here's a question I want you to sit with for a second. Why do so many people with complicated portfolios, 20, 30, even 40 different holdings, end up underperforming the market year after year? It's not because they're not smart. It's not because they don't care. It's because complexity creates decision fatigue. It creates emotional trading. It creates the perfect conditions for you to sabotage your own success without even realizing it. And that's exactly why the minimalist retirement portfolio exists. It strips away everything that doesn't matter and keeps only what does. So let's break down what this actually looks like. The core philosophy, the whole idea behind a minimalist portfolio comes from a simple truth. Over long periods of time, the vast majority of actively managed funds fail to beat a simple, low-cost index fund. Not most years, not some years, the vast majority over decades. Think about that for a second. Teams of analysts with Bloomberg terminals, Ivy League degrees, and millions of dollars in research budgets, and they still can't consistently beat a portfolio that basically just says buy the whole market and hold it. This isn't a fringe theory either. This is decades of documented, peer-reviewed data. Jack Bogle, the founder of Vanguard, built an entire empire on this exact principle, and investors who followed his simple approach ended up wealthier than the ones chasing the hot stock tip of the month. So what does this portfolio actually look like in practice? The 3-fund portfolio. This is the classic, the one that's been tested, back-tested, and lived through market crashes, recessions, and recoveries. Here's the breakdown. Fund number 1, a total U.S. stock market index fund. This single fund gives you ownership in thousands of American companies, from the biggest names you know down to smaller growing businesses. You're not betting on one company surviving, you're betting on the entire American economy continuing to grow over time. Fund number 2, a total international stock market index fund. This adds exposure to companies outside the US, spreading your risk across different economies, different currencies, and different growth cycles. If the US market has a rough decade, international markets can help balance things out. Fund number 3, a total bond market index fund. This is your stability piece. Bonds don't grow as fast as stocks, but they cushion your portfolio during market downturns, and they generate steady income. 3 funds. That's it. No sector bets. No trying to guess which industry is the next big thing. Just broad, diversified ownership of the market, held for decades. Why this works so well? Let's talk about why this simple structure tends to outperform more complicated strategies. First, low fees. Every extra fund you add, every actively managed product you buy into, usually comes with higher expense ratios. Those fees might look small, 0.5% here, 1% there, but compounded over 30 or 40 years, those fees can eat away hundreds of thousands of dollars from your final retirement balance. A minimalist portfolio built on low-cost index funds keeps almost all of your growth working for you, not your fund manager. Second, diversification without complexity. You don't need 40 individual stocks to be diversified. A single total market index fund already contains thousands of companies. You're already diversified. Adding more funds on top of that often just creates overlap, where you're accidentally buying the same companies twice through different funds without even realizing it. Third, and this might be the most important one, behavioral simplicity. When your portfolio has 3 funds, you're not constantly checking 20 different tickers, panicking every time one dips. You have a clear plan, you know your allocation. And when the market crashes, and it will crash at some point, you're not scrambling to figure out which of your 40 holdings to sell. You just hold. And holding, historically, is the single most important behavior in building long-term wealth. How to allocate based on your age and risk tolerance. Now, the ratio between stocks and bonds is where personalization comes in. This is really the only decision you need to make, and it comes down to your age and how much risk you're comfortable with. A common starting rule is this: take the number 110 and subtract your age. That rough number gives you your stock percentage, with the rest going into bonds. So if you're 30 years old, that puts you around 80% stocks, 20% bonds. You've got decades ahead of you, so you can afford to ride out volatility in exchange for higher long-term growth. If you're 50 years old, you might land closer to 60% stocks, 40% bonds, gradually dialing down risk as retirement gets closer. And if you're already retired or very close to it, you might flip that ratio entirely, leaning much more heavily into bonds to protect the wealth you've already built, rather than continuing to chase aggressive growth. The beautiful part? This is a formula. It's not guesswork, it's not emotional. You don't wake up one day and decide you're feeling bullish, so you're going to shift your whole allocation. You follow the plan, and you adjust it slowly, predictably, as you age. The 2-fund and 1-fund variations. Now some of you are thinking, Knox, 3 funds still feels like effort. Fair enough, let's go even simpler. The 2-fund portfolio combines your US and international stock exposure into a single total world stock index fund, then pairs it with a total bond market fund. 2 funds, same core philosophy, even less maintenance. And then there's the ultimate minimalist move, the 1-fund portfolio, using something like a target date fund or an all-in-one life strategy fund. These funds automatically hold a mix of domestic stocks, international stocks, and bonds, and they automatically shift that mix to become more conservative as you approach your target retirement year. With a 1-fund solution, you literally set up automatic contributions, and you never have to touch anything again. No rebalancing, no adjusting. The fund does it for you. It sounds almost too simple to be effective, but the data backs it up. Many of these all-in-one funds have matched or beaten manually managed 3-fund portfolios over long stretches of time, purely because they remove the human error of forgetting to rebalance or panic selling during a downturn. Rebalancing, the one maintenance task you actually need. If you go with the 3-fund or 2-fund approach, there's really only one maintenance task on your calendar: rebalancing. Over time, your stocks will grow faster than your bonds during good years, which shifts your allocation away from your target. Say you started at 80% stocks, 20% bonds, but after a great few years in the market, you're now sitting at 88% stocks. Rebalancing just means selling a little of the outperforming asset and buying more of the underperforming one, bringing you back to your original target. Most people do this once a year. Some do it twice. That's it. That's the entire maintenance schedule for a portfolio that can fund an entire retirement. 15 minutes, once or twice a year, compared to people who are checking their portfolios daily and still underperforming. Tax-advantaged accounts, where this all lives. Now let's talk about where you actually hold this portfolio, because the account type matters just as much as the funds themselves. If you have access to a 401k through your employer, especially one with a company match, that should typically be your first stop. That match is literally free money, and turning it down is leaving guaranteed returns on the table. After that, a Roth IRA or traditional IRA lets you continue building this same simple portfolio with additional tax advantages, either tax-free growth or tax-deferred growth, depending on which type you choose. The beauty is, the 3-fund, 2-fund, or 1-fund strategy works identically across all of these account types. You're not redesigning your strategy for every account. You're just applying the same simple, proven structure everywhere your retirement money lives. The psychology of sticking with it. Here's the part most people underestimate. The hardest part of this strategy isn't picking the funds. It's doing nothing when the market crashes. Markets will drop, sometimes 10%, sometimes 30-40% in severe downturns. And when that happens, headlines will scream, group chats will panic, and your instinct might be to sell everything and wait until things calm down. Historically, that instinct has cost investors enormous amounts of wealth. The market's best days often come right after its worst days. Investors who panic sell during a crash frequently miss the recovery entirely, locking in losses instead of riding them out. A minimalist portfolio makes this easier to handle, psychologically, because there's less to obsess over. You're not watching 40 individual stocks bleed red. You're watching one simple, diversified structure that has weathered every crash in modern market history and came out the other side. That simplicity isn't just convenient, it's protective. Common mistakes to avoid. Let's cover a few mistakes people make even within this simple strategy. Mistake 1. Chasing performance. Just because international stocks underperformed for a stretch doesn't mean you cut them from your portfolio. Markets rotate. Today's laggard is often tomorrow's leader. Stick to your allocation. Mistake 2. Over-optimizing. Some people take the minimalist approach and slowly add fund after fund, trying to squeeze out extra performance. Before long, they've built the exact complicated mess this strategy was designed to avoid. Resist that urge. Mistake 3. Ignoring fees. Even within index funds, expense ratios vary. Always check the expense ratio before choosing a fund. The difference between a fund charging 0.03% and one charging 0.5% might sound tiny, but over 30 years, it can mean a difference of tens of thousands of dollars. Mistake 4. Not automating contributions. The real power of this strategy comes from consistency. Setting up automatic monthly contributions means you're buying in every market condition, high and low, smoothing out your average cost over time. This is often called dollar cost averaging, and it removes the temptation to time the market, which even professionals consistently fail to do. Real-world results. Now, does this simple approach actually hold up against fancier strategies? Historically, yes, remarkably well. Multiple long-term studies comparing simple index-based portfolios against actively managed funds have shown the vast majority of active managers underperforming their benchmark over 10, 15, and 20-year periods. This isn't a knock on those managers' intelligence. It's simply the mathematics of fees, trading costs, and the difficulty of consistently beating an efficient market. The minimalist portfolio wins not because it's flashy, but because it removes the drag that complexity and cost create. So here's the truth about building wealth for retirement. You don't need 40 stocks. You don't need to time the market. You don't need to watch financial news every single day. You need 3 simple ingredients: broad ownership of the stock market, a stability cushion through bonds, and the discipline to hold on through the noise. Pick your allocation, automate your contributions, rebalance once a year, and then let time and compounding do the heavy lifting. That's it. That's the whole strategy. Simple, boring, and remarkably effective. If this video helped you see retirement investing a little differently, make sure you've hit that like button, subscribe to the channel, and I will see you in the next one.